Hello, everyone. Hello, everyone. So we have 17 people in the class today, and we are going to want to talk about ESOP valuation and all the integrities that go into it. We'll just wait for a couple of minutes so that if there are people who want to start, we will do it. Okay. So we'll just start and let people. Are you able to hear me, everyone? Yeah. Yeah. So wanted to just understand that what is your sense on what is ESOP and why is ESOP so critical? So today in the world of especially startups and in fact even large corporates, when you use the word compensation and benefits, the challenge that emerges is that you are just saying that people are being compensated for something that they are losing. So then people say that when we are giving our sweat and blood to an organization's success, we are not happy just with the cash outflow, the cash payout that the company makes. We also want, so it's not just cash outflow, but people also want to be a part of the upside of the company. And that upside can happen only through the equity. So in the world of ESOPs, what happens is you are trying to incentivize employees by saying that boss, stay with us. So typically what happens is that an employee joins in year 0. The lollipop that is given is that you should be staying here till year 1. So that's technically called something called the cliff period. And after that, for year 2, 3, 4, 5, in across the next 4 years, let's say in 48 monthly installments, you will be getting the ESOPs. Okay, and that ESOPs can be substantial. For example, the Swiggy ESOP, Swiggy IPO led to a lot of people becoming crorepati's. More than 5,000 people actually earned more than 1,000 crore, 1 crore each from the Swiggy IPO. So ESOPs actually meant a lot of wealth creation for people. So if you go to the Adarsh Palm Resort area in Bangalore, most of that is people who are the products of the startup ecosystem who minted money through the ESOP route. Now for us, what happens is that when an entity grants an option to an eligible employee, so what happens is that you have to very carefully look at the ESOP plan and see that who is an eligible employee, and then there'll be a grant schedule. So what will happen is to acquire the shares at a future date, but at a predetermined price, thereby giving them an ownership interest in the company. So no one is really interested in being an owner. The idea is that people want an exit. But as an organization, what will happen is that typical grant which will happen is that you will get, let's say, 5,000 shares of the company at rupees 1 each, when the fair market value of the share is rupees 800. Now you can say that, okay, I don't want to account for that cost, but that is something which is the thing that the ESOP valuation has to be done with the intent of getting this whole thing measured and properly recognized. So for example, if you would have, let's say, given 2 crores of CTC to someone in the profit and loss account, that 2 crores would have appeared as an employee cost. Now the startup says that, boss, I don't want to give 2 crores. I will only give 0.5 crores as salary and 1.5 crores worth I'm giving ESOPs. So in case it does not account for the ESOP cost, then this whole cost of 2 crores actually gets understated. So from that perspective, we will have to actually go for the ESOP valuation. Someone just put me on mute. Now are you able to hear me? Oh, I'm so sorry. Someone put me on mute or side. How did this happen? So what happens is that ESOP basically creates a lot of wealth. And the reason why we need to do that accounting of ESOP is that ESOPs have to be going for, like, if the company would have given a 2 crores of cash compensation to someone, as compared to that, if a part of that is being given in the form of ESOPs, and if the company does not record that, in that case, what will happen is that instead of 50 lakhs, that 2 crores of cost is not getting recorded. So we have to do the ESOP valuation to understand that how much is the ESOP worth. So let's say when I'm saying that rupees 1 is the grant, on the grant date, this is the exercise price. And when will I get the ESOPs? I will get it after 2 years. So even if the company's share price is, let's say, rupees 900, I will get this in 1 rupee. And that is where substantial wealth creation is going to happen. Okay. So in terms of types of ESOPs, what will happen? You have an ESOP, which is a plain vanilla ESOP plan where the stocks are getting converted into equity shares on a future date on completion of the lock-in period, which is the vesting period. And after that, you have got the employee share purchase plan. What happens is the company actually buys back the shares at a discount. Enables the employee to buy the shares at a discount and have a lock-in period during which they cannot sell. So that's called an ESPS, which again is not very popular. Just give me a minute. then you've got something called stock appreciation rights, which is what happens is it's a more simple method where you don't have the concept of grant and then employees doing the exercise and then they will sell that in the open price. What happens is that today the share price is at rupees 500. After 2 years, if the stock price becomes 900, this 400 rupees, which is the appreciation, gets accrued to you as an employee in the form of the SAR, and you get to pay salary on that in the form of income from salary. And then there is some classic instrument called phantom stocks. Nowadays, what happens is that based on skills and all, this is done, but this is not so much in vogue in standard companies. It's either ESOP or stock appreciation right, which is there. Okay, so the key terms which are very important for us to understand when we try to do ESOP valuation is what is grant price, the price at which shares are offered to the employees. Okay, so for example, it can be rupees 1, which is like almost at a negligible price. I have given the grant. Some companies do not want to do that. They will say that, okay, today the pre-series round has happened at rupees 400 per share. So the grant price today is locked at rupees 400 per share. And after that, whatever is the appreciation that will happen, you will still get rupees 400 per share. You're not able to hear me? Are people not able to hear me? Yeah, it is clear. I think we can hear you. Yeah. Okay. So then what happens is that in that case, the grant price becomes 400 rupees, which is the current valuation or maybe a discount to that. The biggest wealth creation happens in the case of the ESOPs where the grant price is rupees 1. Vesting period, the period after which the employees can be converted into shares. And this is where the waiting period happens, and because of which the accounting will also consider very significantly what is the vesting period for these options. The period after which the options can be converted into shares. So it can be 1 year and it can be 2 years, it can be 4 years, whatever, depending on how the grant can happen. Now, this is when it vests. What is the meaning of vest? Now, once it vests, I have the right to exercise. And as and when the shares get vested for the company, the accrual of liability comes then. So vesting for me is the point when the costing of the ESOPs will happen. That as and when the ESOPs get vested, in some cases there is something called accelerated vesting. So there have been one company which is going for an IPO. In one of the grant letters, it is mentioned that the vesting will happen normally over the period of next 48 months after a cliff of 1 year. But in case an IPO event happens, then there will be something called accelerated vesting. In that case, all the options get vested in a single go. Okay. So that is something that once you're doing the valuation, you need to be mindful of. And then there is something called exercise price. Exercise, when you actually pay the price, convert the options into shares, and these hit the demat account. And that is where in India, you have to pay taxes also. If you actually exercise the price share today, even if there is no liquidity event, you have to pay the tax based on the difference between your exercise price and the fair market value of the shares. And then what is the exercise period? Now, this is something what happens is that in the Black-Scholes model, what happens is you will have to understand that, okay, the period after vesting within which the employee has to take the decision of exercising the options. So for this becomes critical for us that let's say the vesting happens after 5 years. After that, the options remain alive for another 10 years. And this will be, so the minimum period in which the exercise can happen is 5 years and the maximum period is 15 years. And therefore, in the ESOP valuation model, you take the average of the min and the max and take 10 years as the average. So what are the methods of it? Now, in India, you will have to go for the Ind AS 102 in case the net worth of the company is more than 250 crores. And otherwise, it is the guidance note issued by ICI called Accounting for Share-Based Payments. Okay. Equivalent to Ind AS 102 is, of course, IFRS 2 on the basis of which the Ind AS has been prepared. In the US, it's called ASC 718. Now, on the basis of this, again, As per the guidance note, there are two options. The fair value option can be there and the intrinsic value accounting can be there. What is the method of this? In fair value again, there can be a Black-Scholes method, which is the most commonly used method of accounting for ESOP cost. And then there is also binomial and Monte Carlo. Now, what is this? So Black-Scholes basically is the thing that the options can be exercised at the end of the period. Okay. In case of binomial, it's like a two-way tree that can happen. If you remember, like if you're from a CA background that drill oil and you get oil or you don't get oil. And if you get oil, then you further drill. So for example, so it becomes like a binomial kind of a thing with everything having two nodes and those two nodes further leading to two more things. Okay. And then there is something called Monte Carlo simulation also that can happen. Now, Monte Carlo simulation is very critical. And that is where in the valuation profession also you are able to add a lot of value. So let's say in one of the clients, what used to happen is that let's say the shares are listed on the US stock market at today at $2. The employee will get something called PSUs, performance stock units, at $4, but that will be they will get the shares only if the share price exceeds $4 in the period of the next 3 years. So in that case, what happens? You have to do the Monte Carlo simulation. Monte Carlo simulation, let's say you do a 10,000 simulation run, and we will shortly show you how that is done. So in case of that Monte Carlo simulation, you are able to then simulate on the basis of the past volatility that what is that $2 leading to, and what is the probability of the employee actually reaching that $4 ka threshold and getting the employee these PSUs in their demat account. So for that you require something called Monte Carlo. In case your company is not into Ind AS, then there is something which is very simple. You can just look at the intrinsic value of the stock. That okay, if today the fair value of the stock as per the latest funding is rupees 800 and the grant price is also 800, the fair value of the stock is 0. This is the intrinsic value. And then there is something called time value of money also, which means what? Basically that the stocks, because you're today getting something and 800 is fixed, after 3 years also you'll get it in 800. So there you might, because of Black-Scholes model, get some fair value of that option. So the point is that you have an option and that option has to be valued. Okay. So in case of Black-Scholes, what happens is that you have an European style option, which is simple time-based service conditions or non-market performance conditions, straightforward assumptions, very, very simple to apply Black-Scholes. You yourself can go to on the internet, you'll find a lot of Black-Scholes calculators and apply that and try to understand that what is the fair value of a particular stock. And then there will be, these are European options, which are exercised at the end of the period. Then binomial lattice are options which are American style, which have to be at any point of time where there is flexibility in exercises there. Okay. And then there are Monte Carlo options, which are critical because these options basically are for both European and American style options where there is complex schemes. For example, there could be a option which is linked to the EBITDA of the company. The option can be linked to IPO event. The option can be linked to revenue milestones. In that case, a lot of simulation has to be done to test on the conditions under which that event will happen. What is the probability? And accordingly, the company will also, based on that probability, assign the cost. So in case, let's say I have got 100 options. And for those 100 options, I will have to recognize 1 lakh. Now, in that 1 lakh, is there a 50% probability that this IPO event will happen, or the EBITDA of the company will be 5%, or the revenue will cross 1,000 crores? Based on that probability, I will recognize 50% of that 1 lakh is rupees 50,000 in my P&L account. So it's a very sophisticated kind of a technique in case you really want to build a career in valuation. This is what it should be there. And similarly, in case you are, let's say, the finance controller of a company and your ESOPs are exotic in nature, they are linked to all of these conditions. In that case, they will insist that the Monte Carlo simulation happens. So what are the inputs to the model? Something called spot price, Okay, so which is the fair value today? So which is basically fair value, not exactly today, as on the date of grant. Now, for example, if you do ESOP accounting for a listed company, it's very simple that every day you have the NSE, BSE stocks, stock price, and accordingly you can do the accounting. Okay, but in case, let's say it's an unlisted stock, it's a startup. In that case, there can be grants which are there throughout the year. So when the standard says fair value as on the date of grant, what you'll have to do is that for a period of 6 months, you can obtain a valuation report and say that, okay, this is what the fair value is and the date of grant. Now again, it is a very dicey thing that what is fair value, and you will have level 1, 2, 3 level inputs. So level 1 input is the market participant view. So for example, if the company has recently raised a series A round and that series A is at rupees 1250 per share, that becomes a level 1 input. That will be the fair value as on the date of grant plus minus 3 months from the date where the funds came in the company from the investor. So nothing like it, because a knowledgeable willing buyer and a knowledgeable willing seller have come together and agreed that the valuation of the company is 1250 rupees. However, in case of unlisted companies, sometimes or often that kind of a recent transaction has not happened. In that case, you will take a fair value report from a registered valuer and try to see that what is the fair value as of the date of grant. Okay, so this is the typical number. Then you have something called exercise price. What is exercise price? The exercise price is the price at which you will get the share. So that can be, let's say, rupees 1. It can be rupees 500, whatever. Where will you get this? You will get this from the grant letters. Now, risk-free rate of return again is as on the date of grant. All the cost measurement will happen on the date of grant, the fair value measure. So as on the date of grant, what is the risk-free rate for the what? And so, for example, the risk-free rate of return will be the GSEC bonds. So now that GSEC bond has to be for the duration, which is commensurate with the duration of this particular option also. So for example, if it's a 4 year is the weighted average life of that option, this risk-free rate of return also should be taken for 4 years. And then, so that is risk-free rate of return. If you're taking the US, so let's say the stock is of the US, so it's a Delaware company for which the Indian employees will also get the stocks. Then the Delaware, you will have to take the US GSEC rate depending on that country. Let's say it is Singapore, so then it will be Singapore. Then this is volatility. Now volatility of that stock, that sector, for example, if it is, let's say something like it's a sleeping company, sleep well kind of a company. Relaxo, not Relaxo, Relax Well. So in that case, you have some unlisted companies like Bigfit as the thing. Then you have Sheila Foams as the listed peer. And accordingly, you take the volatility. Again, you also have Ashwatthamaran sets and all on the basis of which this volatility can be taken. And the term to maturity will be the period for which the options will be exercised. Is there any question on this? Because most of the fight that happens with the auditor also centers around these 5 points: spot price, exercise price, risk-free rate of return, volatility, and time to maturity. Any questions on this? That do you have any issues around that? It is very, very critical that these are resolved. So fair value as on the date of grant, exercise price from the grant letter, risk-free rate for the term of the option from the GSEC of the country in which the stocks are there, volatility based on the listed peers, you will get this, or on the unlisted peers also you can get, let's say, Ashwatthamaran data. And then term to maturity, min plus max by 2 is what we had studied in one place. We can do that. Volatility, can you explain more what it means in financial terms? So that stock has a volatility of 40%. So what will happen is, which means what, this option is far more volatile. So if you look at, for example, if you look at the option trade, what happens is that in BSC, NSE, when people trade on, let's say, the Nifty Bank Index, moment the volatility increases, the option price also increases, because options are basically what? they are the product of for you to hedge against volatility. So volatility will be a major factor to, so the more the volatility, so as you see here, what will happen that what will be the fair value of the option in case the share price increases? How comparables are generally considered? Where can we get the country's risk-free rate of return? So the risk-free rate of you will get it on the so CCIL bonds you will get like Clearing Corporation of India bonds, CCIL bonds in case of India. So they give all the bond data, bond trading data. Yes. So that will be on the basis of that, or on these websites like investing.com, you will get GSEC data. So on that GSEC data, you will get the, so the problem with the GSEC data is that it's a discrete rate, and the CCIL bond YTM data is continuously compounded. The assumption for Black-Scholes model is that it should be continuously compounded. So in case your auditor is a big six firm, they will insist that you take the CCIL bond data. Now, Sudeep has a question that compare a listed company with non-listed company for volatility. Yes. So what if a comparable company is not listed? Then you take a sector, whatever is the broadest available thing. For example, if there is a startup which deals with insomnia. So, for example, it creates a device which helps people sleep better. Now, you will not have any listed comparable for that. Then you will look at what is the closest comparable thing, and maybe that can also be health related startups, health related listed company. So like that, you'll have to do that. It's slightly judgmental. Now, strike price, it is inversely proportional. So an option for which the grant price is ₹1 vis-a-vis ₹900, it is very logical that which is a more lucrative option, this is a more lucrative option. So it is inversely proportional. More the strike price, less will be the fair value of the option. Again, if the volatility increases, the fair value of the option also increases. So in very volatile times, you will see that, let's say, bank options, also Nifty options, they also become very highly priced. Dividend inversely proportional here. So let's say if it's a listed company, you will generally get a dividend history for that company. How do you arrive at fair value in case of call options of shares? So fair value will be through the Black-Scholes model. So call option will have a current price. It will have a strike price. So one option will be current price. Second option will be strike price. Then you'll have volatility. Then you'll have dividend and time to expiry and risk rate. So if you give these 6 options, so there are Black-Scholes calculators. You'll also find that online. You will get the fair value of the call option of the shares. Call option is what right to buy. So basically ESOP is a call option. I will have the right to buy the shares of Wipro, and I can also let it lapse. So accordingly, I will look at the fair value. So the Black-Scholes model, the formula is ND1, ST minus ND2, KE. This is a very complicated, which you would have mugged up in case you've done CA final. But yeah, this is what the formula is. Now in the ChatGPT era, we don't have to mug it up. So Priya, to answer your question, this is how the example will be that let's say you have an option for which the grant date is 1st April 2022.
शालू इनको ले जाओ यार, ये बिल्कुल नहीं करने दे रहे.
And then the vesting starts in 2 years. So contractual expiration is 2 years. Fair market value as in the date of grant is 100 rupees. Why not Monte Carlo is what my auditor is asking to follow. So auditors insist on Monte Carlo. It will depend on the fair value. But unless there is some trigger, everywhere Monte Carlo is not required. Monte Carlo is required where there is uncertainty around the fair value. Means they would have asked for Monte Carlo because there is some uncertainty related to, let's say, IPO event or revenue milestones.
Yes, there are conditions attached in case of this call option wherein the document says that if the price varies from this range to that range, then there will be certain rights. And if the price varies, so there are different ranges of the price given at the time of the investor exit. And hence there is a dependency on achieving that price. And then the respective call option will get, exercised. So that is where they are asking us to consider this as a derivative asset in the balance sheet and also arrive at the fair value using Monte Carlo method. Is this,
Obviously, that is
huh?
correct. That is correct.
Okay.
Because they are saying that, let's say it is, let's say your EBITDA is between 5% to 7%, you will get 100 shares. If it is 7% to 9% EBITDA, then you'll get 125 shares. And if it is 9 plus, you'll get 150 shares. Now, so therefore, there are 3 probabilities assigned to P1, P2, P3, which total add up to 1. So in that case, you'll have to assign, so you'll do a this Monte Carlo simulation, arrive at what is the probability of you achieving different EBITDAs, and accordingly the cost will have to be recognized. And of course, it's a derivative because it derives its value from some external thing. So they
So
are
last
right.
question on this is that, is it mandatory to arrive at the fair value for this derivative asset as per US GAAP?
Yeah, because your term sheet has that uncertainty event. Now, in case it was simply time vested options, had it been a simple time vested was you stay in the company for 2 years, like in this our case, what it is, you stay in the company for 2 years, you will get the option. Then there is no need of Monte Carlo. There
Okay.
you will simply say risk-free rate of return is this much, dividend is this much, volatility is this much. So the call option value is 50 rupees, which comes to the calculator. But Monte Carlo will be where and fun. It's fun actually. You have to do Monte Carlo and all. I'll show you maybe some Monte Carlo you can understand.
Okay.
Then there is like a binomial model. It's an iterative process for specification of nodes. For example, you are doing, it comes in different cases. For example, patents. So there are different stages in which patents get application get moves. So at every stage, there is a probability of failure. So accordingly, you make a binomial tree and then the option value will be like this. This will be there, but it's generally not used so much. I have not seen in my limited period here. So what happens? You plot it that the stock price today is 110. The strike price is 100 rupees. So 10 rupees delta is given. Time to maturity 2 years. RF 5%. Volatility 20%. Dividend yield 0%. And then DT is 1 and number of steps is 2. So what will happen is you will plot the possible future of stock prices, translate into option values, and then discount into a present value. So what happens is then the up factor, it will be this, down factor, it will be this. So probability is P is 57%, 1 minus P is 42%. So you will say, okay, 110 today can move to 134.5, it can move to 90.7. And like that, you will find the fair value of that, which translates to 23.76. So that tree has to be constructed, not so much used. And then Monte Carlo is a statistical technique that performs the risk analysis by simulating a range of possible outcomes. In case the share price estimates, so the simulation uses variable inputs resulting in randomized result estimate. So it's a very random distribution. So typical output for that will be 57% probability that the condition will be met. Or 34% that the condition will be met. So like that, there'll be typical probability outcomes. And then accordingly, you will get the Monte Carlo thing. So valuation date, let's say today is this. Expiry date is after 4 years. Trading days are 252 in each year. Let's say it's a listed company. So till expiry in 4 years, total calendar days are 1460. Trading days will be 252 into 4 is equal to 1008. Number of weeks till expiry is this, number of years till expiry is this. So what then we will do is stock price closing today is this, volatility. So now the more the volatility, more the fluctuation in this will happen. So this volatility is a very key number. In case it's a listed company, then you get the own company's listed company's volatility. Otherwise, you take the benchmark. So if it's a travel company, then you take Make My Trip, you take Yatra, you take EMT like that, and you calculate the volatility. So then you take the risk-free rate of return and translate that into a daily return. And the triggers, what will happen is, so which I was talking, if the share price crosses 2.75, you will get 25% of the shares. If it crosses 3.25, again you will get 25%. If it crosses 3.75, you will again get 2.75, and it crosses 4.25, again you will get 25% of the shares. So now the play will be what will be the share price once the period ends. And therefore we will run the Monte Carlo simulation. We will do this whole simulation for the next 1008 trading days. And in case it crosses, so you will find that, okay, here the output will be there. And on this basis, what will be the payoff and what will be the present value of the payoff received on that on the trigger date. And therefore, number of PSUs are this expected to vest. Now see the expectation to vest is not 100%. It is 24%, 21%, 14%, 9%, 6%. So if they were to vest, then you will get this much money on the table. And therefore, the total cost which the company has to recognize is 396,835. This is a very, very interesting thing which I really like doing. Now there is something called graded vesting again. It's a very complex thing again to apply. What happens is there's something called separate. Every grant is treated as a separate cost unit. And what is typically done here is so ESOP expenses are allocated using either straight line method or graded vesting method. So what happens when the options are, you can either have equal expenses over each year. So 1, 2, 3, 4. So I take 25% in each of the years. However, the thing which is there is that this Ind AS talks only about graded vesting method. So when the options have a graded vesting schedule, like 25% each year over 4 years, they should be treated like multiple grants. So employee gets 100 grants, but out of that 100 grants, 25, there are 4 buckets of 25 each. Then those 4 buckets of 25 each should be treated like multiple grants. And the fair value of the grant is amortized over the respective vesting period. Recognizes. So what will happen is that for the year 1, the full cost will be recognized because it gets vested within this year. What gets vested in year 1 and 2, here you will recognize 50% in the first year. What gets recognized in 3 years, you get 33% here. And for the 4th one, you recognize 25%. So if you look at the weighted average thing, you will recognize a much higher cost for this 4 buckets as compared to if you were to just use 25% in each year wala funda. So this leads to what you typically call as front loading of the cost. Because you are kind of accelerated cost booking happens. So for example, the terms of the engagement are there are employees which have employee ID A, B, C, D. The grant date is this, number of options are this. The vesting period is 2 years, 50% vesting in each year. Fair market as per Black-Scholes, let's say, is 50 rupees. Very simplistic. So what do? The fair value of the ESOP is 50 rupees. Options are 100, 200, 400, 300. And the second tranche is again 100, 200, 400 and 600, 300, okay? 50% vesting in each year. So this tranche, for the first year, you had 11 months in this year and 1 month in the next year. You get 12 months. For the other tranche, 11 months in this year, 12 months in the next year and 1 month in that subsequent year. And accordingly, if your total is now 24 months, your options out of 100 will be 46, 50 and 4. And accordingly, you will recognize this cost in 22, 23, 23, 24 and 24, 25. Is this clear? This is thoda sa complex. What you do is that you say that each tranche, the bucket within that tranche, you take a month-wise kind of a breakup that how much of that vesting will happen. So you say that vesting will happen. So let's say the the option becomes fully vested after 2 years, which means even in the first year, the cost is getting accrued. So you have to front load that cost. So here the trigger should be this. This is the point at which the exercise can happen. But within the initial 2 years also, I am booking the cost rather than waiting for the vesting to happen and recognize the cost at that point of time. And then I will do something called attrition ka adjustment, which I will expect that, okay, 5% of the employees might not do that. And this is where the CFO plays. When the cost becomes very high, let's say the cost becomes 15 crores and he feels that no cost, this is going to give a jolt to the P&L. He says, okay, assume 20% attrition, and therefore the expected cost that needs to be booked in the books of accounts is only 12 crores. Now, there has to be, of course, a scientific basis for this 20%. But yeah, depending on that, it can be done. So attrition also can be a fairly important play. Now disclosures, as per Ind AS 102, what you have to do is that you have to show whatever the agreements that existed during the period, settlement methods, vesting conditions, and then you have to look at the what are the number and weighted average exercise price of the share options by category outstanding at the beginning of the reported period and at the end of the reported period, which were granted, vested, exercised, and forfeited. Then what is the average share price of the recognized options? What are the range of exercise prices and remaining contractual life? Valuation methods used to determine the fair value, Black-Scholes model, etc. And the impact on the income statement, total expenses, and carrying amount of liabilities of share-based payments. These are the disclosures that will happen in the books of accounts. So designing ESOP is a balancing act between managing the cost to company and estimated wealth creation for employees. So the company basically worries about this, the employee worries about this. So you have to evaluate potential wealth creation at vesting across business scenarios to align terms with the desired outcomes. So this is as far as the presentation was concerned, where we have talked about Monte Carlo, we've talked about binomial, we've talked about Black-Scholes, the 3 methods under which the cost has to be recognized. And typically the framework, which is either guidance note on share-based payments issued by ICI or Ind AS 102, under which this whole accounting happens. Now I will also try to show you some real examples. Yeah, but yeah, we've seen that. Also, there is something called option pricing method, which your auditors will insist. What is the thing that is also very interesting in case you've got like the big four auditors. What they will do is that they will also insist on something called OPM model to be applied. Now, what is OPM model? Basically, what is the logic there is that now in the cap table of a company, for example, there is CCPS, which is being issued. CCPS series A, B, C, D, E. There are multiple series CCPS. Then there is equity, which comes. And then there is ESOP, which comes. Okay. Now, the different series A, B, C, you will have something called liquidation preference. And anti-dilutive clause. What that means is, any guess what is liquidation preference and what is anti-dilutive clause? Which makes CCPS a superior instrument as compared to equity. because it is far more powerful as compared to the equity shares. So there is something called liquidation preference, which means what? That boss, I have invested 1 crore in the company in Series A. In case the company gets liquidated, I will get 1.25x liquidation, which means 1.25 crores out of that liquidation will come to me. So there is something called LP which is there, which will be assigned to each category of shares. And then there is something called anti-dilutive clause also. What happens, and this has actually got triggered, let's say in case of Farmeasy, that there was an investor which I issued in the invested in the company at 40 rupees. Subsequently, the company went for a down round and issued shares at 20 rupees. And this guy has become a fool. So he will get additional number of shares for free, such that he gets the same voting power in the company that would have existed had these shares not been issued. So then there is something called anti-dilutive clause. Because of this, CCPS is a superior instrument as compared to equity shares, and further to equity shares, ESOP is even an inferior instrument because there is something called DLOM, which you have to apply here. Any guess on what is DLOM? DLOM. So there is something called discount for lack of marketability. If you look at typical grant letters for ESOPs, you will see that there will be this condition that under no circumstances that you can sell it in the open market. Whatever happens, you will have to sell it back to the company only, or in case the company facilitates a liquidity event for the employees, only then you will be able to sell it. In that case, what happens is that your ESOP shares are further inferior. So that what will happen is, so let's say if the company's valuation is $2 billion, you will allocate that under option pricing model called OPM, option pricing model. You will allocate it to the different classes of instrument, and you will arrive at that cost. What is the fair value of equity shares? Under ESOP, the equity shares which are issued, what is their fair value? So you will do the cap table allocation, and OPM is a fairly standard practice that will be applied in case of companies where there is a complex cap table and there are liquidation preferences, where there are anti-dilutive clauses, etc. And then you have equity shares, and then you have equity shares. After that, you have the ESOP shares. So ESOPs may you will have this DLOM and all which is applied. But if you apply the this option pricing model, you will automatically arrive at, okay, if the series A, the recent series E has happened at 1,200 rupees per share, which corresponds to a $2 billion value for the company. It does not mean that the equity shares are also 1:1 make conversion, because the difference is LP and anti-dilutive. So therefore, it could so happen that the equivalent equity value is 850, and for your ESOPs equity, you will again apply 85% factor to adjust for DLOM. So that is where the adjustments happen in case of these companies, that you make all of these adjustments. Okay. So now we are in the last 10 minutes of the discussion. How does waterfall in OPM work after preparing cap table? So Janvi, yes, that is the thing, that that whole waterfall mechanism has to be applied, that in case the company were to get liquidated, so this $3 billion will get allocated to the different classes of instruments. So that is where the fun will come. I think this is very complex. And so this, I had an article, you can just search it, valuation perspective journal mail. Page 20, just remove it. Yes. So here what will happen is that in such cases where there is a complex cap table, what does the Option pricing model too. So the background there is that just not able to run it. Yes. So it can be ESOPs, restricted stock. This all we have studied. That's not a problem. CCPS में anti-dilution clause is there. Then the earlier investor will have more rights as compared to investors who come in later at a higher valuation, and etc. Now, option pricing model using Black-Scholes model will happen is that each class of share is considered as a call option on the equity value of the firm. And then the firm's price is therefore set according to the preferred stocks liquidity option. This model indicates that the company share will have significant value only if all of those other classes of people are paid off, and only then what comes to the equity shares will be considered for the OPM model. So in the OPM valuation model, there'll be waterfall analysis. You'll draw the cap table of the company. That's the first step. And consider things like what is the liquidation preference, what is the participation right, what is the conversion right, what is the anti-dilutive clause. So accordingly, let's say you have all of these class of shares, that founder shares are itna, ESOP shares are itna, Series A preference shares, Series B preference shares, and then you have options. So accordingly, the price at which they are issued are also at 1. So then you have capital committed, you've got ownership, and accordingly, you prioritize each security class under waterfall mechanism. So you create like what is the strike price at which who will prefer. So basically you do that stacking and you create that waterfall analysis. These are typically called breakpoints. And therefore what happens is at the first stage enterprise value is 0. No one participates. Then LP for series A and B comes. Then the ESOP gets exercised. Then the options get exercised. And then conversion of series A and B happens. And accordingly, the strike prices will change according to, and finally, on this basis, you will allocate using option. So there's a complex template here like this, it will happen. You'll find what is the incremental value of each options and percentage of value allocated to each class of shares will come like this. And then you will apply a DLOM, private company ka, and get the value of, let's say your share will be 175.73 per share. This will be the whole beauty of this particular method. Okay. The link to the article, I'm just putting in the chat box. Yeah. Any other questions, please? Is Monte Carlo method the preferred method? No, not at all. It depends on the conditions. Black-Scholes method is the most commonly used method. In case there are events around uncertainty related to, let's say, EBITDA, revenue, IPO event, this, that, then you will have to do the Monte Carlo simulation for that. But Monte Carlo generally is not applied unless you have a very strong Big Four firm, etc. that will be there. This will not come into the picture so much. So typically ESOP valuation will happen once a year in a company to understand the accounting charge that has to be put as part of the closing account. So listed companies generally do it in April, and then startups will keep dragging it and all. EY auditors prefer. So again, as like the Priya's case, what happened? There were conditions that there are slabs in which, depending on, it will have to be seen that what is the term sheet. So performance-based vesting have to be mandatorily using Monte Carlo, of course. If it is PSUs, it will have to have Monte Carlo, because how will you identify the outcome in which this is happening? That will be only using Monte Carlo simulation.
Anurag, can you also please touch upon the tax aspect of these charges that will hit the P&L?
Tax aspect.
Yeah. As in, it is allowed?
So tax is very clear that as on the date of exercise, irrespective of whether there is a liquidity event or not. So
I'm talking from the perspective of companies' returns, whether under the like US or as well as in India, will these ESOP charges be allowed as a deductible expenses?
for deductibility of the expenses.
Yeah.
That there is a chart set of journal entries that
Mm-hmm.
will be, so it will be knocked off mostly against securities premium only.
I see. You're
Yeah.
saying that securities premium that we carry in our balance sheet can be used to offset these charges?
No, the charge will come to your P&L,
Right.
but after that, what will happen is that that will also be set. I am showing you the set of journal entries. Just a minute.
Sure.
So the this is which will happen. Now, FEMA implications can also come when we actually exercise shares. But taxability, yeah, that is a very gray area because assessments have for my clients have not happened as of now, whether it will be charged or not. But
You have considered it as deductible?
that I will come back to you. I will just once check because I actually
Sure.
have not seen that. But generally, the income tax, what happens is anything which is a provision in nature is not allowed. So this is the set of journal entries which will happen, that employee benefit expense account to share-based payment reserve year-wise, which will happen. And once the exercise happens, it will bank account debit, share-based reserve debit to equity share capital to share premium. And then, so like that, the journal entry will happen. So I think what will happen typically is that once the vesting happens and the exercise happens, then the department will allow you to tax that. But I will come back to you on that. I will just check because we have never done the tax filing for those clients for which you've done the ESOP.
Okay, no problem.
Now, this is also very, very interesting thing. As per 192, generally what happens is that there is not immediate liquidity upon exercising. So then the perquisites, if it is taxed upfront instead of on the liquidity event, then the department had also mentioned, if it's a Startup India recognized scheme, then such startups can defer TDS within 48 months of the end of the relevant assessment year, cessation of employee or sale of ESOP shares. So generally you can postpone it. Like, let's say my options get vested today at 1 rupees each. I can happily exercise them and get them in my demat. Then I get the comfort that whatever happens, I will not be shortchanged. But the moment that happens between 900 and 1 rupees, that or 899 becomes a perquisite in my hand. And I am not been able to sell that 900 rupees shares in the market. So then that 900 rupees, 30% tax I have to pay. So for that, in some cases, if it's a DPIT registered startup and all, you get an exemption. Okay. And in case there are any other issues, I'm always available on LinkedIn. Will it not be considered as part of salary once vested? Not once vested, once exercised. So the company keeps booking employee stock option, and then this grant, we have seen how the journal entries are falling. Accordingly, that will happen. Okay. Yeah. Okay, then thank you everyone for joining. And this event, the recording is available on YouTube, on my YouTube channel, because it was also done as a live event. So